Welcome to The Explainer. Today, we are stripping away the confusing jargon to investigate the absolute foundational mechanics of global wealth. If you've ever found yourself wondering how money is really generated, how it's concentrated, and how it's distributed on a massive macro scale, you are absolutely in the right place. We're going to map out the hidden architecture of the global economy, using direct source material to understand exactly how the financial system actually works. Okay, let's dive into this with the most fundamental question of our entire economy. Where does money actually come from? It sounds like such a basic question, right? But the answer literally dictates the flow of power and resources across the globe. Now, most of us have a deeply ingrained assumption about this, kind of a mental model built from years of conventional wisdom. But as you'll see, facing the reality of money creation is the very first key to unlocking this whole puzzle. So, we were all taught this textbook myth, right? You deposit your savings into a bank, and the bank just acts as a middleman, lending your money out to a borrower. Well, the reality, as detailed in the Mon Economy documentary The System of Money, is entirely different. Commercial banks actually create money out of thin air whenever they make a loan. When you sign a mortgage or a business loan, the bank doesn't move someone else's money into your account. No, they just type numbers into a computer, simultaneously creating a matching deposit and brand new money. Now, I know what you might be thinking, but this isn't some fringe internet theory. This is authoritative reality. We're talking about a direct report from the Bank of England's quarterly bulletin, and it explicitly states that money creation in practice completely differs from popular misconceptions. They confirm that banks do not just act as intermediaries lending out deposits. Instead, they state it plain as day. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. And to really wrap your head around the scale of this, get ready for a genuinely staggering number: 97%. According to that same Bank of England report, 97% of all the money currently in circulation exists merely as bank deposits created by these commercial loans. Physical cash, the actual notes and coins printed by the central bank, that makes up just a tiny fraction of the money supply. The vast majority of money in our modern economy is entirely digital, literally brought into existence by private banks extending credit. Section 1. Central banks and the flow of money. So, while commercial banks create the money we use every day, central banks control the underlying spigot. They set the interest rates and do the large-scale asset purchases that dictate how fast money is created and where it goes. But when a central bank adjusts that dial, who actually feels the impact first? Well, we have to look all the way back to 1755 and a concept called the Cantillon effect, which was highlighted by the Curiosity Chronicle. Richard Cantillon noticed that the flow path of new money matters immensely. His theory basically says that those closest to the source of new money, the early recipients, benefit the absolute most before prices start to rise. Think of it like a giant trickle-down effect. If a central bank opens the monetary spigot, the huge financial institutions and asset holders standing right underneath get a flood of wealth, while everyone further down the chain just gets a trickle. But does this 18th century concept actually hold up today? To find out, we can look at some recent academic research from the Political Economy Research Institute at the University of Massachusetts Amherst. These researchers analyzed the real-world impact of expansionary monetary policy, specifically lowering interest rates, on wealth inequality in the U.S. over several decades. They wanted to track exactly what happens to different wealth brackets when the central bank makes it cheaper to borrow money. And this brilliantly illustrates the modern Cantillon effect in action. According to the study, when the central bank implements an unanticipated 100 basis point rate cut, the top 10% and the top 1% actually increase their share of total wealth. Meanwhile, the bottom 50% and even the middle 40% see their overall share of wealth shrink. And the research emphasizes that these aren't just quick blips. These effects are statistically significant and they persist over a 5-year medium term. Since the wealthy hold a disproportionate share of assets that benefit from lower borrowing costs, the new money basically inflates their portfolios first. Bringing this abstract data down to a real, tangible metric, the study calculates that this specific monetary policy directly increases the Gini inequality index by up to 0.015 points over 5 years. Now, on a scale that goes from 0 to 1, where 1 is total absolute inequality, a 0.015 movement caused purely by central bank policy changes is highly significant. It proves that the very tools used to manage economic activity have built-in systemic impacts on how wealth is distributed. Let's move to and see how this builds into Section 2, the shadow banking system. So, beyond the regulated banks we all know, there lies the shadow banking system.
This is basically a massive collection of non-bank financial intermediaries. We're talking hedge funds, structured investment vehicles, money market funds. They provide credit and increase market liquidity just like traditional banks do. But here is the major difference. They do it entirely outside of normal banking regulations. They don't take traditional deposits, and crucially, they completely lack access to central bank safety nets or deposit insurance.
Now, if the term shadow banking sounds a bit like a conspiracy theory, I promise you it's anything but. This is a highly recognized, heavily monitored ecosystem. Former U.S. Federal Reserve Chair Ben Bernanke formerly stated, "Shadow banking comprises a diverse set of institutions and markets that collectively carry out traditional banking functions but do so outside the traditional system of regulated depository institutions. It is a fully acknowledged parallel system that drives global credit."
And the sheer scale of this unregulated network is jaw-dropping. According to S&P Global estimates, at the end of 2022, the shadow banking sector held about $63 trillion in financial assets. Just to put that into perspective for a second, that represents roughly 78% of global GDP. This alternative banking network has grown so vast that it rivals and, in some areas, completely overtakes the traditional banking system when it comes to supplying loans to businesses and consumers.
Section 3. The Petrodollar Empire. All right, let's zoom out to the global stage here. How does all this domestic money creation actually translate into international dominance? Well, it's all about the petrodollar. This cycle is essentially the engine of American global financial leverage, and it traces its roots back to a 1974 agreement where Saudi Arabia agreed to price oil exclusively in US dollars. Step 1. Because oil is priced in dollars, every country needs dollars to buy energy, which creates a constant, massive international demand for the currency. Step 2. Oil exporters receive billions of these dollars. And Step 3. Rather than just sitting on all that cash, they reinvest these petrodollars into U.S. assets, mostly treasury bonds. As Economics Help points out, this continuous cycle effectively finances U.S. trade deficits and keeps U.S. borrowing costs significantly lower than they normally be. And extending right out of this global dollar demand is something called the eurodollar market. A declassified CIA document actually highlights this phenomenon. It's a massive $1.5 trillion market of US dollars held offshore, mostly in London, and it operates entirely outside the control of the US government or the Federal Reserve. This is essentially an outlaw market where huge London-based banks set the terms of lending and dictate interest rates on a vast ocean of American currency. It really showcases just how much of global finance operates in the shadows, completely beyond the borders of traditional regulation. Section 4, the global debt trap. Which brings us to the final and really the most human element of this whole explainer. What happens when this massive macro machine presses down on vulnerable economies? Well, the Mon Economy documentary introduces a really critical lens for viewing this dynamic, calling it financial imperialism. This is described as expanding and maintaining power not through military force, but through pure monetary dominance. The documentary argues that the global financial system often forces debtor nations to severely cut public spending and restructure their entire economies purely to increase exports. The goal essentially becomes generating enough foreign currency, usually dollars, just to service their international debt, which completely halts their own domestic development. And the real-world statistics on this are absolutely staggering. According to a UN report detailed by The Guardian, 113 developing countries right now spend more on servicing foreign debt than they do on education. Debt repayments by poorer countries have recently hit a 35-year high, largely driven by systemic shocks like those global interest rate hikes we talked about. At the exact same time, aid to these lower-income countries dropped by 21%. And to make matters worse, private lenders, who are often rooted in those shadow banking hubs we just discussed, frequently block debt relief agreements just to protect their own profits. So the crucial point is this: developing nations are being forced into an impossible choice. On one hand, you have servicing global debt to foreign private lenders and international bodies, and on the other hand, investing in the basic education, health, and infrastructure of their own citizens. The mechanics of the global money system basically dictate that servicing the debt must win, which systematically drains the potential for growth right out of these nations. To put a really sharp point on this, just look at sub-Saharan Africa. According to the data, countries in this region are currently spending 3.6 times more on repaying foreign debt than they are on educating their own children. I mean, think about the long-term compounding effects of a choice like that. It creates this brutal cycle where these countries can never develop a strong enough tax base or domestic economy to escape their reliance on international debt markets. Zooming all the way out on the entire system we've just mapped today, a core imbalance really reveals itself. On one side, the system facilitates immense private wealth creation. Banks generating money through loans, shadow banks operating completely outside regulation, and those lucky enough to be closest to the monetary spigot accumulating massive assets. But on the other side is the public burden. Time and time again, as the documentary sources point out, systemic risks and private debts are transformed into public debts, and those are paid for through austerity and taxes by everyday citizens, in both the developed and the developing world. Which leaves us with this final thought to carry with you. When a financial system creates money out of thin air through simple accounting entries, yet demands repayment in the form of real-world austerity, stripped public services, and constrained human potential, who does it ultimately serve? It's a question that really challenges us to look past the daily headlines, to question the foundational mechanics of the global economy, and to keep digging deeper. Thanks so much for joining me for this explainer, and as always, keep your curiosity focused.